Hi, everybody. This is Gary Dean with Sentiment Timing, and this is our weekly video report for Wednesday, May 3rd, 2017. Tonight's video is going to be a little bit different. It's going to be a little bit of an educational video as well as a little bit of technical analysis. But tomorrow, I'll send out a full technical analysis video, and you guys will get an idea as far as where we are. But I think it's important to go over some things that we've been getting a lot of emails as far as questions about our service and what makes us different and stuff like that. And I think tonight's video is going to really help educate a lot of people. So, at Sentiment Timing, what we believe is that human beings and the markets are irrational, and there's always going to be an irrational element at work, and that's what creates the market opportunities. Now, we're going to show you how we find these market opportunities and the process that we take, and it's pretty interesting on how things work. So, our main purpose, as far as finding a directional trade, is we use time, and that is when the trend it will reverse. And Woody does that through his technical timing indicators, and they're usually weeks in advance. And then the sentiment is the data that Woody gathers. He's been doing it for over 40 years, and it gives us kind of a barometer of how the herd is feeling about the market. And it's a the herd mentality is important, and that's going to be a big part of this video tonight because market extremes or reverses are going to come at sentiment extremes. So we have the when we have the time, and then you have the what how the herd is feeling, we're able to use technicals to try to determine where price will reverse. So what is the difference between regular technical analysis and sentiment analysis? Well, the difference between say regular technical analysis is that uses price. So there's a ton of them out there. You have your RSI, your MACD, your money flow. I mean, you name them. There's a ton of them out there, and people use all different ones to come up with it. But there's one common element in all of the technical analysis like that, and that it uses price to determine the reading for that particular technical tool that you're using. Now with sentiment, it's actually giving you a reading based on how people or how traders are feeling about the current trend. So it's a forward looking indicator where price is a reaction indicator, meaning that the RSI is, it's going to go up as price goes up, but there may be some divergences. And that's what I do on the technical aspect of sentiment timing. I look for the divergences and stuff like that. So I'm not saying that technical analysis is useless. It's actually very useful. But the thing is that sentiment is, it's based off of how traders feel. So if everybody knows how to trade technical analysis or use technicals and divergences and Elliott waves and fib retracements, is there any really element of surprise? Because if everybody's using it, everyone's going to actually be making the same type of trade. So to use a system that everybody uses, it's useful. Don't get me wrong, it is. But there really is no predicting when things are going to turn. And if you think about it, do you think that the largest financial institutions in the world are using regular technical analysis to make their trades? No, they want to use something that not a lot of people know of and they don't follow. And your everyday trader, they don't know how to track investor sentiment. They don't understand it. They don't understand how to trade it. So institutions have been, depending on Woody Dorsey's sentiment data for over 40 years. And there's a reason why they do that, because it's an element of surprise. If they see everybody leaning one way, whether it be bullish or bearish, they're going to start moving their positions in the opposite side because the retail investor is going to be wrong 95% of the time. And that's mainly on the trading end of things. You're buy and hold, when you're in your IRA and stuff like that, that works, but you're not using any kind of technical analysis. The technical analysis is for traders, and the institutions use these against them because the majority are usually following them, and they're all leaning to one direction. But the thing is that when everybody's leaning on one direction, you have to remember that the trend reversals happen at sentiment extremes. So whether it be on the bullish end or the bearish end, they're positioning their portfolio on the opposite side of what your normal retail trader is doing. So as I said, your regular technical analysis works, but often what happens is traders get stopped out of positions, and because the main reason, and I've said this numerous of times, is how can you determine where price is going to reverse if you don't know when it's going to reverse? And that is really the biggest difference between, say, our service and many others, because we combine how the herd mentality or sentiment is with when price is going to reverse, and that's through Woody's his technical timing indicators, and then from there we use regular technical analysis to try to determine where price is going to reverse. So if the S&P is trading at support and showing bullish divergences, those are buy signals, but the reversal date or a technical turn date isn't for another 5 to 8 days. Can you see how traders will jump the gun and either be buying that support, but it's going to be right before a larger drop is happening because their technical analysis is not lined up with time. And if the S&P is trading at resistance and showing bearish divergences or sell signals, but investor sentiment is still at bearish extremes, so everybody's bearish and institutions know that, so they're going to push price higher and get all of those traders that are shorting the market at resistance because that's what they've been trained to do. And from there, that's where you see these explosive moves to the upside, and why so many traders get stopped out and get trapped and then end up trying to chase the trend. So to see the full picture of the market, like I said, I mentioned that technical analysis works, but when it's used alone, it sometimes catches people, and it works, let's say 70% of the time. But the thing is, if you really want to increase your odds on getting into successful trades, you really have to you have to combine that with when the market is going to reverse, and that's the technical timing analysis that Woody does. And then you combine it with how traders are feeling, because, like I said, trend reversals happen when we are at sentiment extremes. So when everybody thinks the market's going up and we have a technical timing indicator that's looking for a reversal and sentiment is at bullish extremes, guess what? Institutions as well as our subscribers start positioning ourselves for a decline. And you have to wait for some type of indicator or indication that the trend has changed. But from there, you're in it right from the beginning, and you're not buying the market as when you're listening to these financial news stations telling you that it's going to the moon, and vice versa when it's dropping and they're saying that we're going to zero. That's what influences investor sentiment. They're watching the TVs, they're reading, other people that are trying to promote their own really positions, and they forget that everything is based off of investors' emotions. So once you get the when, and the as far as when to expect it and how investors are feeling, then you can start using technical analysis to determine where it's going to happen. So just like an example of this would be that um, Woody was looking for the micro kill zone, and it's always been a micro kill zone, meaning that this was not going to be a crash. This is going to be There's going to be a series of drops, and they're going to be bid back up. And the thing is that the kill zone, it was going to occur in March, and it was going to be a buying opportunity. So if we look at this, you can see that we had on March 1st, we had a 99% bullish sentiment reading, meaning that everybody was listening to the financial stations and we were heading to the moon. And that marked the exact top on that particular time period. And from there, we headed down. So now what I'm going to show you is this is that on April 4th, we knew that this downside was going to go into either April 20th or the 19th. So for the next 2 weeks, the market was going to be in a downtrend. So let me show you how technical analysis would work on that. So here's our top. Everybody's been buying the dips here, and this is going back from the elections, and it's been working. So here we had a gap up, and this was on March 1st, and now the market's dropping right here. We're at support. We're pretty oversold right now, and it looks like a great place to buy. Well, you did get a bounce, but look what happened after that. We took out these lows, and look when it made a bottom right here on the. This was. I'm sorry, this is in March. This is March 27th on it. So this is the beginning of the range. But we knew going into this that we weren't going to get a real low until the 19th, which we actually made an actual low here, but it came up and came down. And on the 19th, which is right where my cursor is when the market exploded higher. So when it was here, should you have been building a big short position? Absolutely not, because we are oversold. We had our momentum was heading up, and this was the day that we were looking for the low. So it wasn't the exact low. You can see that actually took place on the 27th, but we came down and tested it again. And if you bought thinking that this was it, as we started coming down, most likely you're getting out of your long positions right here because you're thinking that we're going to be crashing. And then when we popped up and came back down again, it was like the same thing over and over. And we had a very, very bearish reading here. And from that, we saw an explosion higher. So my point is this: if you don't know when to expect these turns, and how investor sentiment is lined up, technical analysis is going to get you stopped out of positions more than they're not, because it's going to, if you were trading the long side here and just said, okay, when the S&P takes out this low, this is my technical damage and I'm getting out. Well, it made a little low and then pop back up again. So the thing is, if you know that when you start, you have to start positioning your trades on the long side or the short side, it gives you a trading advantage over everybody else out there, because not many people have Woody Dorsey that's letting them know when to expect a turn, having sentiment to back up that, and then just using technical analysis. So just a quick little thing here. What I've been saying and what Woody's been saying is that we are going to be in a range, and we just stay neutral. And when we're at tops, sell them. We're at lows, buy them. And this range is stuck in place. And anybody that's looking for a swing trade right now and has been buying the breakouts has been just finding that they're getting washed right back out again. And once we took out these lows, everybody that started shorting the market, guess what? Now they're underwater on that. And there's a reason, because we're not ready for a top yet. We're not there for the meaningful decline to take place, because we already know when that date is. And there's a couple of them that we're going to be looking at, but a significant drop is not yet here. And that's when knowing when to expect the markets to decline gives you an advantage, and you just turn into trade mode if you want to get in. And on top of that, we really don't have any kind of sentiment extremes to be looking for an extreme top or a bottom right now. So you just stay in trade mode with the knowledge that we're going to be in a range. And yes, we could head higher, and it would make perfect sense as this Elliott wave pattern is showing. But we're not banking on any of that. We may just stay in this range right here. So the technical analysis, it works, and that's what I do for sentiment timing. And as what with Woody's turn dates and sentiment, those aren't going to change that much. Knowing in April 4th that the top is coming on the 19th, how many different ways can you really tell people that the top is coming on the 19th or the low is coming on the 19th? I'm sorry. But the technical say framework is going to change daily. And that's what I do with morning notes. I give them out and let you know where the range is and whether, we're expecting the market to go up or, down for the day, and whether to stay in trade mode or start building a position for a swing trade. And that's the way you really like control your emotions, is probably the best way to put it. If you're in trade mode, you're not looking for the big moves. So when you're at support, if you're short, you cover. In when we're heading higher, you're not looking for an explosion to the upside. So when you get to resistance, you cover your or you sell your long positions, and you're just in trade mode. But once we get into the swing trade mode, that's when you're able to build a position, and that's when you get the bigger moves that are going to last 2 to 4 to 6 weeks, and that's really until the next until Woody's low date or high date is coming. So hopefully this helps, and it shows you a little bit different way to look at the market and gives you kind of a full perspective as far as what to expect. So right now we're in a range. We're not expecting a breakout. We're not expecting a breakdown. Tomorrow I'll do a little more elaborate technical analysis video. And with that, have a great night, and I'll talk to you guys tomorrow.